Good afternoon, everybody. Going to go over our Forex trades for today, Friday, April 4th. Actually, we didn't have any scalp trades, but we did have a swing trade, which was euro to dollar. We were short this 1.37215. If you had the guts to hold it through this morning's non-farm payroll, you could have picked up a bunch more, call it another 30 pips or so. But as it is, we picked up 15.1 pips. Not bad. On that trade at all. As far as the non-farm payrolls and economic numbers that came out this morning, non-farm payrolls came in pretty much in line, 192,000 new jobs created, and unemployment, they claim, stayed steady at 6.7%, actually missed analyst expectations by 0.1%. They were expecting 6.6%. So here the government is claiming that 192,000 new jobs were created, unemployment stayed steady at 6.7%, and the economy is getting better. But guess what happens? The gold rises in price, treasury yields go down, and stock market opens about 0.4% higher, and the U.S. dollar actually didn't really do all that much, as you could see there, the gyrations. So the government wants us to believe the economy is getting better, but yet the smart money or the big money, whatever you want to call it, on Wall Street, obviously is not saying that. If the economy is getting better, gold is certainly not going to rise. Treasury yields certainly aren't going to go down, and stock market, obviously would pop higher. But the fact is, the smart money is viewing it where the economy is not getting better, and that's why you had gold rise, treasury yields fall, and the stock market jump. The stock market's been doing the opposite. Good economic numbers, the stock market actually goes down these days, and bad economic numbers, the stock market actually goes up. That reason being, or at least that thinking, is that if the economy remains weak, the Fed will continue to do quantitative easing, which is keeping interest rates at all-time lows, weakening the dollar, making prices of goods and services more expensive, and also the stock market more expensive because capital has nowhere really to flow. You're going to stick it in the bank for a 0.25% annually a year. You're going to put it in, bonds and treasuries at, whatever, 1.5%, annually. No, the majority of investment money is going to go to the equity market. Again, our theory has been all along that the Fed is pretty much painting themselves in a corner. Yes, they've been reducing QE slowly, trying to wean a child off of, chocolate or whatever. Hopefully it works. If they do it, they're thinking if they can wean the market or the economy off of QE slow enough that it may not create a panic in the stock market. One's going to find, or I guess we're going to find out. The other side of the coin is, let's say they slowly reduce QE and the big money, the smart money, decides to panic and the stock market starts to get hit, down 15, 20, 25, 30% in a few weeks or a month or whatever, one big swoon of 8 or 10%. We believe the Fed's going to step right back in and say, oh, all right, well, we need more quantitative easing, so they'll ratchet it back up again. So I don't know. That's what we believe could happen, very easily could happen. I hope we're wrong for everybody's sake. I hope the Fed can pull it off. I hope they can wean the economy and the stock market off of QE on a slow pace, and the market will continue to go higher, and the economy will actually show real strength. We could go on talking about this forever. Anyway, so as far as our trading went, like I said, we picked up the 15.1 pips, and we'll move on to next week. If you're trading now, good luck. If you're looking for any more swing signals, I don't know, maybe more will come. And if that's it, if you're still trading now, good luck. Have a great weekend, and we'll be back next time we get some action.